Hey, welcome to the podcast, everybody. Thanks for joining me. Today is Wednesday, April 11th. The stock market is closed, and as you can see from the screen, complete opposite of yesterday. A lot of green. Well, not the complete opposite. I guess the complete opposite would have been that the Dow Jones Industrials would have been up over 200 points as they were down over 200 points yesterday. But nevertheless, the Industrials up about 89 points, back above 12,800. Obviously, the bulls would love to see that back over 13,000. Big psychological level. You can see the transports were a little stronger than the industrials today. Utilities lagged. Not a big shocker on a day where it's not about safety. It's about risk on. I know you probably get tired of hearing that term, but it's actually what happens. It's an overused term, but it's a term that I think is highly appropriate because, unfortunately, and this happened last year, you tend to get these days where everybody goes extra risky, and risk is on, buying materials, financials, emerging markets, technology, or risk off, which means treasuries go up. Yesterday, gold went up. Consumer staples held in there. So it is an appropriate term still. As you can see, everything was, again, pretty much up across the board. And, of course, Russell 2000, smaller stuff, leading the way up, just like they led the way down yesterday. I think really when you look at today's market, I guess it could be, I almost view it as a disappointment from the bullish standpoint. And the reason why is we had a 90% downside day yesterday. Everything was thrown out, high volume. So you should expect a rally over the next few days. And you could say, hey, well, the Dow was up 90 points, the S&P was up almost 11, the NASDAQ up 26, about 0.8%. The Russell's up more, semiconductors up, treasury rates up. What more do you want? Well, we sold off from our highs, and really the high was reached early in the morning. So that's a negative. And the cause for the rally, when you think about, we had some economic data today, but you had Alcoa's earnings, which were better than expected. Not great, but better than expected. You had that. You had yields coming down in Italy and Spain, which has been a bugaboo for the market the last couple of weeks. And then, of course, we get hit with the Indonesian earthquake. And that, of course, was on the negative side. That's not a positive. But anyways, so you had some positive things going on, and we were oversold. However, we're still not oversold enough in the intermediate term, meaning the next few weeks. So I don't necessarily think the sell-off is absolutely over. It would be very bullish if it was. But the fact that we're up at 1375 this morning on the S&P 500, and we close at 1368, we gave up, 0.5%. One other thing to note here is if I zoom in a little bit in the last few months, this is a 50-day moving average, and you can see the sell-off as it's been going down. And what I want to point out is the fact that we rallied back to the 50-day. After breaking through it yesterday on very heavy volume, we rallied back to it and fail. And so now that becomes your reference point. Can the stock market bounce through that point? And I think this was the point some of the bulls were looking for and saying, hey, can we bounce off the 50-day yesterday? We've been falling the last few days. Can we bounce off that? And can we hold this level? Because this was the previous breakout point. We'll call it around 1374. Well, it just blasted through that on the downside, which you can see right here. So, that happened. Can we go back above it? And we did, but we couldn't stay back above it. So now, this is now your ceiling. It was the floor. Now it's the ceiling, as it was the ceiling here until it finally broke through. And that was a pretty good buy spot back in March. And now, of course, it is failing on the downside. So haven't gone through because I wanted to get this out, and it's going to be a fairly short one today, but I haven't looked at all the internals. But I suspect this was more a function of an oversold short-term bounce than it was anything meaningful. You have to have follow-through. If tomorrow we were up another 75 or 100 points and it was stronger volume and the internals were great and all the sectors participated, great. But again, a bounce of really anywhere from a few days to a week is perfectly normal after a 90% downside day like we had yesterday. So we could bounce, and where could we bounce? We could still be making these higher bounces, and then it could roll over and head back down. That's possible, and that would be normal because, again, after a 90% day like yesterday where everybody's throwing everything out, the baby out with the bathwater, to get a rally like we did today is perfectly normal. Now, what cracks me up, of course, is everybody was short yesterday, right? You hear on the CNBC and Bloomberg and listen to the radio, everybody knew this was coming. Everybody had cash. Everybody was short. And then magically today, everybody was long, and everybody was perfectly positioned to buy the dip, even though we had this big gap up in the morning, right? If you bought at the open, you actually lost money today because it opened. First few ticks were high, and then we trailed off as the day went on. So as that first few ticks came in, if you bought that, you're either flat or down a little bit. Now, if you bought it first thing, maybe you could made a little bit. If you bought it an hour or 30 minutes into it, then you actually lost money. So the point is, it didn't just go up all day long. Those gains happened while you were sleeping. And so it's interesting that people went from short to long in 24 hours and when the market was closed. But I digress. The way I'm positioned and the way I've been positioned through this is you hear about the Goldilocks economy. Not too hot, not too cold. Well, I've had the Goldilocks investment approach, which is not too long, not too short, not too hot, not too cold. I am short the Russell 2000 in one of my strategies to hedge. So yesterday it did well while everything else went down. But I also have cash and some lower beta and some income producing securities. So on a day like yesterday, I can sleep. Was I net short? No, I was not. Did I, go all in today? No, I was not. And I don't think we should let the last few days dictate our position. I think we need to see, do the bulls hold firm here and buy this thing and say, that's it. We've seen a drop from 1422, 1423 on the S&P 500, and which was up here. And now we're down here, and this is it. We think that's enough, and we're going to buy this thing, and up we go. Can the bulls do that? And if they do that, fantastic, But the proof's in the pudding, and we're not seeing either way. So, again, don't get overzealous and sell everything. Well, yesterday wasn't the day to do it. Some things may have gotten stopped out, and that's fine. That's just portfolio management. But I don't think you should make a major bet on which direction it's going to go just yet. I feel like, from a timing standpoint, that a bounce was likely today. It happened. Is there going to be some follow-through? That would be perfectly normal. But I'm not sure that intermediate, meaning the next few weeks, we don't see potentially more selling, and maybe even some selling that makes it look like this whole thing that's been in place since November, December is ending. That would cause the fear to spike up even more, and then at that point, you could see the market rally, fake people out, and start heading up, because in the next few months, I think the stock market still hasn't given us an indication that it is rolling over. There's too many indicators that I still believe are heading in the right direction from a technical standpoint. Now, keep in mind a couple of things. It's important to understand that in the summer of 2010 and in the summer of 2011, we had some pretty major corrections. Now, technically, this was a bear market in 11 because it broke 20%. 2010 got real close. I think it was, depending on which market you looked at, 16 to 18%. But both of those, in the big scheme of things, the fact that we have made, we made new highs after this one, and we made new highs after that one, they were corrections. And I called this one a bear market. And again, technically, was I right? Yes. Positioning-wise, was I wrong? Yes, because ultimately it didn't just keep going down like a traditional bear market. It snapped back. So let's just say there were corrections. And it makes more sense because, again, there weren't these warning signs like 2007 where everything was falling apart. So I believe that even if we go through a sell in May and go away, and we go through this choppy summertime, I think ultimately this may still be a correction. One thing that I'm worried about is, and I've mentioned this before, the volatility really picking up over the next few months, simply because A, it's been low and it goes through cycles, and B, we're going to come into the election season, and now that you see the candidates shaping up on the Republican side, or candidate, now you're going to see the uncertainty begin because, in all likelihood, Mitt Romney has one set of beliefs and one way he's going to take the country. And on the other side, President Obama has a totally different view and has a different direction he wants to take the country. And that leaves a lot of people up in the air about what direction the country is going to go. So that means uncertainty for you. That means uncertainty for me. That means uncertainty for corporations. That means the Apples of the world continue to hang on to a bunch of cash. And I think that volatility will continue. We're starting to see the volatility pick up as we speak. So that's what I think we can look forward to later in the year. But I'm not sure what the next several months hold. I'm just telling you, I still don't see indications that the 1422 was the absolute top. But certainly a correction has been due because we went straight up from December without really anything except for a brief little sell-off in March. This has been a little more significant. And quite frankly, if you're bullish and you think it's going higher, this is what you need. You need a little fear base coming in. You need a little bit of sell-off. You need some corrections. And you need, for the cash you have, better entry points. All right, like I said, this is going to be a short one, but I did want to touch on Apple quickly because, yes, something very unique happened today. Can you guess what it is? I'll give you about 1 second. Okay, your second's up. It lost money today. Now, it lost money today. Is that a huge deal? No, it lost money yesterday as well. But it lost money and the NASDAQ was up. So the stock market went up without Apple participating. This is something that, again, is quite strange. And I don't know if we've seen, I haven't done the research, but I can't remember the last time that happened. So I am starting to get the frothiness and the speculation and the it's never going to go down routine. And I think that's a big concern for Apple, just from a stock standpoint. It has nothing to do with about the company. They were hit with, I think, a lawsuit or something today. But the big picture is that it's still a cheap stock. But from a stock standpoint, this is very rare what it's doing, and obviously you probably know that. But you start looking at things on here, and a lot of you use all kinds of technical patterns and so forth. But when you start looking at things like, MACD, you can obviously, it was bouncing around, and now it's, seems to be rolling over. And I think the other thing is if you do own this and you're saying, what should I do? I think one thing to do is to look at the moving averages on this. And you can see I've got a 20-day moving average, which it bounced off of back in early March. Maybe use that as your stop, okay? And I think that's not a bad thing to do. I think the stock market is, Apple is in a place where due for a real correction. And I'm talking a correction that could bring it down to the 50-day moving average. The stock market kind of looked like this, a few weeks ago. And now what you're seeing is the stock market having a real correction. Is it anything to panic about? No. But Apple's going to go through something at some point, and maybe this is it. I don't know. It's got 2 down days in a row. Is it going to go through something that makes people really question it? Because so far, none of these pullbacks have been anything that people really get concerned about. The long-term bulls are not concerned yet. If it breaks the 20-day moving average, then perhaps that's the time. Right now it's at 610.56. So you're talking about another $16, which would be a decent 3% sell-off. If it goes down and breaks through that, then you do have to start worrying about the next level, and the next level could be, the prior breakout level, which we'll call it right in here. And again, that's starts converging with the 50-day, which is going to continue to move up. Obviously, the 50-day is going to keep going up for some time based on the previous 50 days being higher. So around the 555 area, 560. So could it see that type of sell-off? A $70 sell-off, that would be over a 10%. That would be something that is highly likely. And then maybe it could bounce from there. And I think if you haven't been in Apple, then that would be your spot. And as you know from previous podcasts, I had a very nice profit in it, sold it about a month ago, and have been watching it go up ever since. So I would love to re-enter Apple, but it's getting to that point where people don't think it'll ever go down. And we know that it will. just from a stock standpoint and not even from a valuation standpoint. So it's something to watch out for. But today was one of the first days I can remember in forever that Apple went down and the stock market went up. Just to sum up, tomorrow, producer price index is coming out, initial jobless claims coming out. Remember, something that kind of kept this rally going was a lot of the economic data was beating estimates for the longest time, and in the last few weeks we've seen some of that not happen, and some of these things come in a little weaker, and people are going, oh, wait, maybe the economy is not as great as we thought. And I'm here to tell you, I've been consistent saying I don't think it's as great as people think, but it's been better than the estimates, and that's what's been driving this. Also, rates in Italy and Spain were going down the last few months. They've obviously ticked way up here in the last few weeks, and that's given the market concern. And commodity stocks, there was a big divergence. I did a blog post on that a couple of weeks ago. There's been a big divergence between commodity stocks not confirming this rally, and now the S&P 500 and all the other markets are starting to catch up to that. So there's been some divergences, and certainly a correction has been something that has been long overdue. But is it a garden variety correction, or is it a summer of 2010, summer of 2011 correction? And again, it's too early to tell. But if you have to answer that question tonight, then you're probably not positioned properly for your emotions, because that's a big deal. Because if you're positioned to where you're going to lose a ton of money if it's a bigger correction, then you have too many stocks. On the other hand, if you don't make any money on a day like today, then you're too heavily positioned out of the market. Okay? All right, guys. Twitter.com/Carl Eggers, Google plus Carl Eggers, EggersCapital.com, etc., etc. Thank you very much. Have a wonderful evening.